Hello. Today we're going to be discussing investments, and that's the subject of Chapter 12. Remember that an investment is a case where the company that we're doing accounting for has purchased an ownership interest in another company. So this is an asset like a building or like equipment, but this is actually where the company we're doing accounting for has bought part of another company. We have several possibilities, and I hesitate to call these choices because they're really not choices. It's more like we go through some steps, some thinking, and depending on what type of investment we have, drives what type of accounting is done for the investment. So the first type is a consolidation, and this is where the company we're doing accounting for owns 50% or more of the company it invested in. If this is the case, there's a course called Advanced Accounting. You don't necessarily hit that if you're getting an accounting degree from us, but if you're doing college transfer and going to a four-year school where you're going to study accounting, then Advanced Accounting is a subject in that curriculum, and you consider consolidations. You don't consider them at all in this class, and we don't worry about consolidations in this chapter. We would do what's called the equity method if the investor owns from 20% to 50%, or if the company that we're doing accounting for buys a 20% to 50% interest in the other company. If they have less than a 20% interest, and if you think about it, if you're someone like me who owns a few stocks, but there's millions of shares and you own 10. If the company operated like that, and sometimes they do, then they're not thought to have significant influence. And I want to point out this significant influence issue gets to, can the company we're doing accounting for influence or manipulate the worth of the company that they've invested in? So for example, if they own all the stock, they can do good and bad things to change the value and arbitrarily change it if they want. But if they only own 10% of the stock, 5% of the stock, they really can't do anything to affect what the shares are worth. And so in this case, we have three different types of accounting we could do, and here there are some choices. So there's no choice if you're above 50%, no choice if you're between 20% and 50%. But if you're below 20%, there are three general choices: held to maturity, available for sale, and trading. And I want to say here that if we think the primary two investment types are stocks or bonds, remember stock is really an ownership interest in the other company, bond is we lent them money. If it's a bond, then really we could consider all three types. The bond could be held to maturity, the bond could be available for sale, and the bond could be a trading security. But if it's a stock, then we really don't have all those three types. Stocks can't be held to maturity. There's no such thing. So if we own a stock, we really have to think about available for sale or trading. Now, by the way, on the overview video, I think I said that for bonds you can only do held to maturity or trading, and that's not true. You could also do available for sale. But on stocks, the held to maturity category doesn't apply. Well, first let's think about the held to maturity category. So what if a business buys a bond? So if you think about it, there's a couple ways this could happen. Our company, let's call it Bill's company, could go buy a General Motors bond from General Motors. That's really just lending them money. The other thing Bill's company could do, though, is it could go to a stock exchange or a bond exchange, and it could buy a GM bond from the XYZ investment bankers. Well, for us, there's no difference. It doesn't matter if the bond came from General Motors directly or if it came from the investment banker. Once we buy it, we have to think about whether or not it's held to maturity. So if a company was willing to swear on a stack of Bibles, and that's my term, I've heard that applied loosely now and then, that they would never ever sell the bond before it matures, then we would consider it a held to maturity bond. And if it's a held to maturity bond, we really account for it the same way we would account for something like a building or equipment. We totally disregard changes in the fair market value as we continue to own it. But I've got to ask you, is it fathomable that a company would own a bond and never under any circumstances be willing to sell it? I worked with this category when it came in, when we first developed this standard back in the early 90s, and I always thought this held to maturity category wasn't legitimate. Honestly, back then, companies were looking for a way to not have to show changes in the market value of the investment, the market value of the stock or bond, as a gain or a loss. And the standard setters at the time said, well, if you call it a held to maturity bond and you swear you'll never sell it, then we won't make you record changes in market value. Again, I don't think this category is legitimate for anything, but even though I don't, as sort of an accounting standard setter mind, I know this rule exists and it's permissible. And if I'm doing accounting for a company and a company buys a bond, I would say, do you really think there's a good chance you won't sell this and you just hold it until maturity? Because the way this has worked out in practice is that companies have been able to change categories, put a held to maturity bond into the available for sale category at a later date if they decide it should be available. Well, if it's held to maturity, as I said before, we record the asset at cost and we never revise it. So here's an example. If we bought General Motors bonds for $1 million, including any costs we paid to investment bankers or anybody to help us make the transaction, then we would debit GM bonds or investment in GM bonds for $1 million. Remember, that's an asset now. In both principles of accounting and coming up in chapter 14, we're going to learn that if we borrow money, it could be a bond, and then that would be a bond liability. But here we have an investment or a bond asset. And then I'm just showing the credit to cash. No additional entries will occur unless at some point this investment goes bad and there's some damage to the asset value. And I want to tell you, as you deal with intermediate accounting, that general rule, if there's impairment, if there's damage to the asset, we always revise. There's no condition where you wouldn't revise if you knew the asset was worth less than you paid for it. So only thing that would cause us to change a held to maturity investment would be impairment. Now, if a company buys, if a company's in business to buy or sell stocks and bonds, like if we're doing accounting for an investment banker or a finance company, then when we buy the investment, let's say it's Norfolk Southern stock, as I did here, we're going to debit investment in Norfolk Southern stock $1 million, and we're going to credit cash for $1 million. But notice what we do next. Every time we produce a new financial statement, we do an adjusting entry. We look at what the market value of the stock is, and we do an adjustment. In this case, we're imagining that it's a loss that we looked, and at the end of the quarter, when we did an adjusting entry, the stock lost a little bit of value. And so we show a debit to unrealized holding loss. This is an equity account. And if you think about it, it's an income account here because this is trading. So, this is just like a loss on the sale of an asset or something. It's recognized. It reduces net income. And our asset is credited for $25,000. We don't directly credit investment in Norfolk Southern stock. It's no accident that these two accounts have different names. This one is an investment in Norfolk Southern stock. This one's called fair value adjustment. These would both have 100 numbers, but they're not the same account. Notice on the balance sheet then, if the company is in the business of trading these, that the net investment is $975,000. Now, what if the company buys a stock or bond? I've put the Norfolk Southern stock example back, and they truly might sell it at a later date if the price is right. Every stock, by the way, stocks can't mature, so the only two choices you have are trading if you're in the business of buying and selling stock, or available for sale if you're in a different business. So let's imagine here that Bill's got a landscaping company. He's not in the business of buying and selling stock, but his landscaping company's done well, and he bought some as an investment. So there's the debit, investment in Norfolk Southern stock, credit cash, each for $1 million. Now when the same loss shows up that we looked at on the last page, notice we don't run it through income. This may be a little hard to read, but we're running this through equity. So it's net unrealized holding loss, and it's debited, but this is a debit to equity. So if you remember back from principles of accounting, equity goes up with credits, down with debits. So this is a reduction in equity. And then we have a credit to fair value adjustment, which is an asset account, same as investment in Norfolk Southern stock. And when you put the two assets together, the debit for $1 million and the credit negative asset for $25,000, again the investment's $975,000. So what's different between available for sale and trading, and this is a big difference, corporate executives really care about this, is if it's a trading security, it reduces net income. That's what you saw on the last page. In that example, you saw net income going down by $25,000. In this example, net income doesn't go down. Equity goes down. And you might say, well, I mean, that's a shell game. Net equity reduces, a loss in equity or a reduction in equity. Let me rephrase. A loss reduces equity, and whether it's recognized or unrecognized, if loss is going down, it's all the same thing. Perhaps, but a lot of times corporate executives are worried about what the net income shows. That's what the press reports. And so if they don't have to report it a net income, to them it's a bit of a plus, even if it still pushes equity down. All right, so we're going to wrap up with what happens if we have a 20 to 50% interest, and as a result, we're required to use the equity method. So here, to set up this example, I show Bill debiting investment in Bill's stock for $1 million and crediting cash, but in this case, the company bought a 30% interest in Bill's stock. So you might think of our company here as ABC. Don't get hung up on the bills. So we might be doing accounting for the ABC company. The ABC company buys Bill's stock, buys 30% of it. That's not a controlling influence, but it is significant influence. So we debit investment in Bill's stock by $1 million, credit cash $1 million. Well, if we're using the equity method, then every time Bill's produces a financial statement, we have to record a portion of Bill's net income. So remember, we're ABC. We're not Bill or Bill's company. But we have enough stock, enough ownership interest, that when we get our copy of Bill's income statement, remember, Bill's is going to have to produce an income statement, balance sheet, statement of stockholders' equity, and statement of cash flows. And when we get that income statement, we're going to have to take the $100,000 of net income, multiply it by our 30% ownership interest, and we raise our investment in Bill's stock. These are the same general ledger account. They might have the same, let's call it account 141 number. And this is revenue. So this would be part of our net income. Different line from sales or different line from fees income, but revenue just the same. Then in the last entry here, if Bills, that's the subsidiary, if Bills declares a dividend, we record 1/3 of that, or I'm sorry, 30%, not 1/3, because the 30% ownership is not quite 1/3, but we record 30% of the whole dividend issuance. So we record 30% of the $10,000 dividend and show a debit to cash. That's what you'd expect, even if it was, a dividend in a company that we didn't have significant influence in. If we get cash, we're going to debit cash. But what's different here is we're actually reducing the amount of the investment. So we're acting as if the receipt of the dividend reduces our investment. All right. Well, I know the chapter can be a little confusing or difficult. As I think I told you in the introductory video to it, it's one of the areas I've spent the most time in as a professional. I enjoy this area a lot, and I can certainly answer any questions you have about it. Take care and good luck.